But beneath the opinions is something deeper. 3 vehicles, 1 market, and a fundamental question. Are we trying to win the game, or are we trying to survive it? Let's step back. Imagine it's early 2000. The dot-com bubble has inflated to historic proportions. Technology stocks dominate headlines. Individual investors are opening brokerage accounts at record rates. Companies with no profits are valued in the billions. The narrative is simple. Buy the right stock and you'll be rich. Many did, and many didn't. Between 2000 and 2002, the Nasdaq fell nearly 78%. Individual stock pickers who concentrated in tech saw years of gains erased. Some companies disappeared entirely. Now fast forward to 2008, a different crisis. Financial institutions collapse. Even diversified portfolios fall sharply. The S&P 500 declines roughly 57% from peak to trough. And yet, those who held broadly diversified index funds and stayed invested eventually recovered. By the early 2010s, markets had surpassed previous highs. So what changed? Not human nature, not risk, not opportunity. What changed was structure. To understand stocks, ETFs, and index funds, we need to understand what they represent. A stock is ownership in a single company. It is concentrated exposure to one business model, one management team, one competitive environment, one balance sheet. If you buy shares of a technology company, you are implicitly betting on its innovation, its margins, its leadership, and its ability to outperform competitors. The reward can be extraordinary. Early investors in companies like Apple or Amazon multiplied their capital many times over. But the math is unforgiving. Research from academic studies has shown that a surprisingly small percentage of stocks account for the majority of long-term market returns. In fact, over several decades, only about 4% of publicly traded U.S. companies created the net wealth above Treasury bills. The rest either matched market returns or underperformed. This means stock picking is not just about being good, it is about consistently identifying the rare outliers. Now let's consider index funds. An index fund doesn't try to guess which company will dominate. It simply tracks a market index, such as the S&P 500 in the United States or the Stoxx Europe 600 in Europe. It holds all or most of the companies in that index, weighted typically by market capitalization. Instead of betting on one story, it buys the entire narrative. The logic behind index investing is grounded in market efficiency. Financial markets aggregate information from millions of participants. Prices adjust rapidly to new data. For most investors, consistently beating this collective intelligence after costs and taxes is extremely difficult. And the data supports this. Over long horizons, the majority of actively managed funds underperform their benchmark indexes after fees. This isn't a moral failure, it's mathematics. Fees compound negatively. Trading increases costs. Timing errors erode returns. Index funds minimize these frictions. Then there are ETFs. Exchange-traded funds. ETFs are not a separate asset class. They are a structure. Many ETFs are index funds packaged in a way that allows them to trade intraday on exchanges like individual stocks. Others track sectors, commodities, bonds, or specific themes. An ETF can track the S&P 500. It can track emerging markets. It can track cybersecurity companies, or clean energy, or European government bonds. So when people say, I invest in ETFs, What they often mean is they prefer the flexibility and accessibility of that structure. But the underlying exposure could still be an index strategy or something much more concentrated. And here is where misunderstanding begins. Many investors assume individual stocks are inherently risky and index funds are inherently safe. That's an oversimplification. Risk is not about the label. It is about concentration and behavior. Owning a single stock is concentrated risk. Owning an index fund spreads risk across hundreds or thousands of companies. But an ETF that tracks a narrow industry, say biotechnology startups, can be as volatile as any individual stock. Similarly, an index fund tracking the entire global equity market still carries equity risk. In 2008, broad index funds declined sharply. Diversification does not eliminate market downturns. It reduces company-specific risk, not systemic risk. The real conflict is psychological. Stock picking appeals to our desire for control and distinction. If you choose the right company, it feels earned. It feels intelligent. It feels like insight. Index investing feels ordinary. It feels passive. It feels like settling. But the evidence suggests that in aggregate, the market rewards discipline more consistently than brilliance. There's another layer: costs. Suppose two investors each invest $100,000 for 30 years, earning an average annual return of 7%. One pays 0.05% in annual fees through a low-cost index fund. The other pays 1% in combined management and trading costs. Over 30 years, that difference compounds dramatically. The lower-cost portfolio can end up tens of thousands of dollars ahead, purely due to expense drag. Compounding works quietly, but relentlessly. Now consider taxes. ETFs and index funds, especially those structured efficiently, often generate fewer taxable events compared to active stock trading. Long-term capital gains rates are generally lower than short-term rates in the US, and many European jurisdictions also differentiate by holding period. Frequent trading erodes returns not just through commissions, but through tax friction. Again, structure matters, but we must be balanced. Individual stocks offer something index funds cannot: asymmetry. If you identify a transformative company early, the upside is not capped by the average of the market. A single extraordinary stock can change a portfolio's trajectory. Entrepreneurs, venture investors, and concentrated equity holders have historically built enormous wealth this way. However, this path demands deep research, emotional resilience, and the acceptance of significant drawdowns. Concentrated portfolios experience higher volatility, and most companies do not become outliers. Index funds and broad ETFs offer statistical alignment with economic growth. As global GDP expands, as companies innovate collectively, diversified investors participate in that aggregate progress. They do not rely on predicting which specific company will dominate. They rely on the persistence of capitalism itself. But this approach requires patience. It requires accepting that there will be years, sometimes a decade, of underperformance relative to hot sectors or speculative booms. It requires the humility to admit that matching the market can be enough. There is also a structural shift worth noting. Over the past 2 decades, passive investing has grown dramatically. In the United States, assets in passive funds have overtaken those in active funds. Similar trends are visible across Europe. Critics argue this concentration could distort price discovery. Supporters counter that active managers still set prices at the margin. The reality is nuanced. Markets are ecosystems. Passive and active strategies coexist. One provides liquidity and price discovery. The other provides low-cost access and scale. Another misunderstanding lies in timing. Many investors move between individual stocks, sector ETFs, and broad index funds based on recent performance. When technology stocks soar, they abandon diversified funds. When markets fall, they retreat to cash or defensive sectors. Behavioral finance has consistently shown that this reactive movement reduces long-term returns. Investors tend to buy after strong performance and sell after declines. The vehicle becomes secondary, behavior becomes decisive. In truth, the most important variable is not whether you choose stocks, ETFs, or index funds. It is whether your strategy matches your temperament. If you lose sleep over volatility, concentrated stock picking may test your emotional limits. If you crave intellectual engagement and are willing to endure swings, researching individual companies may be fulfilling, even if you allocate only a portion of your portfolio to that pursuit. Many experienced investors quietly blend approaches. A core allocation to broad index funds provides structural stability. A smaller allocation to individual stocks expresses conviction and curiosity. The proportions vary, but the principle remains. Structure the portfolio around both mathematics and psychology. History does not tell us which single stock will dominate the next decade. It does not guarantee that past index returns will repeat in the same pattern, but it does reveal persistent principles. Diversification reduces idiosyncratic risk. Costs compound. Behavior often undermines returns more than volatility does, and markets over long horizons have rewarded participation more reliably than prediction. So when someone at that dinner table insists that stocks are superior because of a recent gain, or that index funds are the only rational path, it may be worth asking a different question. What problem are we trying to solve? Are we trying to outperform neighbors in the short term? Or are we trying to build resilient wealth over decades? Are we optimizing for excitement or endurance? Because the market does not reward confidence alone. It rewards alignment between strategy, structure, and time. And perhaps the real distinction is not between stocks, ETFs, and index funds. It is between those who chase outcomes and those who design systems. Which one are you? This is Finance Guro, where we don't chase noise, we study reality.